Welcome back to another episode of the Indy Investor Pod. I'm Brett Snodgrass, and I am with my good buddy Justin Bogard from Indianapolis, Indiana today. And we're going to be talking about notes, the note business. We're going to be going over what is different about investing in notes versus investing in properties. When buying a note, what are some of the due diligence things that a buyer should go through? And what are some of the things to really look out for, what to do and what not to do when investing in notes? Let's get to the show. And welcome back to another episode of the Indy Investor Pod. Like I said, I am Brett Snodgrass, and I'm with my good buddy, Justin Bogard. What's going on, man?
Hey, man. How you doing, Brett?
I'm doing fantastic. Thanks for being on the show today.
Well, thanks for having me, man.
Yeah.
I look forward to being on this new podcast you got going on.
I know you're on my other podcast, Real Estate Investing with a Purpose, a while back, and that was about 100 episodes ago, actually, so it's been a while.
Yeah, 100 episodes. It seems like years, right?
Yeah, definitely. But man, I'm really excited about this show. This show is very intentional, number one. We don't pick people just out of the blue. A lot of people ask us questions about certain things that they want to know about in investing. And the note business is kind of like a boutique type of business that it's a great business, but it kind of sits over here where it doesn't get a lot of attention, but it's people that get into it are really into it, right?
Absolutely.
Yeah. There's the note guys out there, and you're one of them in Indianapolis. And I know you've done a lot of education and you educate people yourself, teaching other people about notes. And this is going to be just kind of down to the basics about, I just have some rapid fire questions because we're starting to sell notes. And I didn't realize that people just have a lot of questions about the differences between investing in notes and investing in houses. So I want to just kind of go through some questions, and some of these might sound very simple, but we'll just kind of start off there. So number one, can you just describe what a note is and what is it?
A note is simply a promise to pay. So somebody says, hey, I need to borrow some money to go fund this deal or to go buy this thing. And they just borrow money from somebody. So that's essentially what a note is. So a note could be credit card debt, really, because you're borrowing money off your credit card because you got to pay it back. It could be a check that you write to somebody. It could be, buying an automobile or a boat. I mean, all those things you typically would require money to go borrow to go get that item or that asset. And real estate is no different. We go out and we get a mortgage so that we can buy a house after our down payment. And that's kind of how what the description of a note is in my mind. So the loose term note is, in our industry, we concentrate mainly on real estate. It could be invoice debt. It could be, lottery winnings or NFL contracts. It could be all that stuff.
Interesting. I guess I never really thought about when I think of notes, I automatically go to real estate, but it's basically debt, right? Someone giving you money or giving you credit to use money, and you promise to pay them back, right? At a certain rate.
Exactly.
So interesting. Yeah.
Exactly.
So it could be all sorts of things, but today we're really going to focus on real estate because this is a real estate investing podcast. So basically a note is, what are the things involved with the note? So the promise to pay, what's a good structure of that note?
So the best description I can give you is just that any one of us that wants to buy our primary residence, we typically have some sort of down payment, like we mentioned before, and then we go to a bank, like a Bank of America or one of the larger banks, and we say, hey, look, we require more money to buy this house for ourselves. And then so they go through an underwriting process, and they typically give you what's called a note and mortgage. So the note is one document. It's the promise to pay. And the second document is called a mortgage. And the mortgage is a security instrument that basically says if me, the borrower, defaults on this contract, we'll call it, or this promise to pay, then that bank can take back the collateral, which is the house that I'm purchasing. So the note and mortgage is always the best way to structure a deal. In different states, they call it deed of trust and other other naming conventions, but for all intents and purposes, we all know a note and mortgage. So they said mortgage loosely, but it's really a note and a mortgage. So it's two documents that are married together.
Interesting. Interesting. So I guess it always comes down to people sometimes don't understand when they actually buy their primary house that they're actually signing a note, right? They know
Yeah.
the term mortgage and they
Mhm.
think that they're signing a mortgage, but the note outlines their promise to pay and their rate and all that. And the mortgage is basically the security instrument. So it's kind of like a car. If you buy a car, there's a
Yeah.
title, and the person who loans on that car holds the title.
Yeah.
Same thing here. You hold the mortgage, right? And no one, they can't ever sell that house without paying off the person, right? Paying off the lender. And that's
Exactly, which is why we have title companies that review that entire process of what liens are on the real estate, so they know what debt is to be paid out of those proceeds coming in from someone buying the home. So the seller has to pay all the debt or all the liens on the property.
awesome. Sounds good. So that's basically what a note is. I want to just talk about the differences between investing in notes versus investing in properties. They're
Okay.
both passive. Let's just take Indianapolis, for example. A lot of people out there buy
Yeah.
Indianapolis houses to rent. So what's the difference between buying a note and buying a rental house?
Well, that's a great question because they on the surface they appear to be the same thing. They're both cash flowing investments. So if you're the bank on something versus the landlord on something, you're receiving income monthly, but the underlying values are different. Where when you're the landlord, you actually own the property, so you're liable for it. You got to get insurance on it. You got to pay the taxes on it. When you're the bank on the property, or you have the note on a property, you actually step back from any liability. You don't actually own the house. You just own the debt on the house. So you get the best of both worlds. You get the cash flow from the asset, but then you also don't have any responsibilities of the property. That is the homeowner or the borrower's responsibility. And then you have every right to the property if the borrower defaults on them, because that is the promise to pay contract, so to speak, that the borrower signs at closing.
Interesting. So you get a lot of the benefits, the cash flow,
Yeah.
without the liability. So you basically own without owning it, I guess.
You own nothing but control everything,
There you go.
right?
You own nothing but control everything. So you literally
Yeah.
are the bank.
Yeah.
And I love that term because why do people rob banks? Because that's where the money's at, right? So if you can be the bank, that's good. And a couple other things, just the some of the liabilities too that come with owning a property as a rental are you have to take care of the property, maintain the
Yep.
property, fix up the property, um, all of that, right? So all that kind of gets taken away when you own a note and you own a bank, but you get the benefits of the cash flow. So, what are the pros and cons of owning notes versus rentals, right? So we talked about some of the benefits that you control a lot, that you
Yeah.
control everything without owning it and no liability. But what are some other pros? And then talk to us about cons.
Oh man, I gotta put a negative light on my favorite subject. Come on now. Well, I think it's obvious. I've experienced being a landlord, and I've experienced being a note investor or the bank as well. And so the pros to it are what we just explained before. So if you own a piece of property and you're renting it, you have a tenant. So you have to deal with turnover, and you have to deal with someone that may not want to take care of that property as best as you would take care of it as if you live there. And that's the main difference between a tenant and a borrower, right? The borrower is going to have a equitable interest in the home because they're gaining equity in the home every time they make payments, and they also, that home is theirs, right? And so when you have when you're a landlord, that you have that's kind of the con to being a landlord, and it's kind of the pro to being the note investor or the bank. So the reverse of that, there also are good things about owning rental properties, as you know, is that the rental property can appreciate in value, right? And you can take depreciation off of your taxes and things like that. And a note, you really don't have that. You have the unpaid balance that the borrower owes, and then every month that kind of ticks down. Now you do make interest on that, but it ticks down. So if you have to look at it two different ways. So if you're in it for the long term, both can be beneficial, and both can, you can look at it as a potential like depreciation where you can't capture it on a note versus a rental. So all in all, there are some more complicated things we can get into about depreciation, recapture with rentals and things like that. But all in all, that's kind of the main differences. Do you want to own the home or do you want to be the bank on the home?
Yeah. No, that's good. I was thinking about you get a little bit more tax benefits, obviously owning rental properties.
Yeah.
I think it just depends on who you are and what you want.
Yeah,
And I think that's just the
exactly.
bottom line. Like, for example, I own 80 some notes, something like that. And we own, let's just say a dozen rentals. Like, we don't do a lot of rentals, but as far as the maintenance involved and the headaches involved versus owning 80 notes and then a dozen rentals, the dozen rentals take up a lot more time, a lot more headaches
I
than the
believe
80
it.
notes.
I believe it.
Yeah. So I guess again, but if you want the long haul and you want the tax depreciation, then there could be a mixture of both. That's why we kind of do both, right? So
Yeah.
awesome. Why do you think notes is a safe investment, rather than stock market, mutual fund, or rentals, things like that?
Yeah, I think any real estate investment is going to be a lot better for you than the stock market, just because in real estate, it's so resilient to economic downturns. Even what we're going through right now with the coronavirus and having quarantine and being shut down in certain areas for essential and non-essential businesses are still struggling. Um, but real estate is resilient because it comes through and it always comes back up in value and always gets stronger and stronger. So if you have collateral that is real estate, when you're the note holder, you obviously have that as collateral, or if you're a landlord, or if you just fix and flip houses or you wholesale houses, you always have that real estate. It's always going to appreciate. It never goes to zero, right? Because in a stock market, things can go to zero, or guess what? It can go below zero, which nobody really likes.
Mm,
And it's so volatile. I mean, we can go on and on about that, but it's the volatility of the stock market that people don't like, and it's the predictability of real estate that people like. So with notes, it's going, up and up and up like this, and so is the real estate value of the collateral. So I feel like those are the reasons why there are safer investments, or lower risk investments. I shouldn't use the word safer.
yeah,
So they're lower risk investments because the collateral always going to be more than what you have into the deal.
definitely.
Yeah.
I love it. I love it. Yeah, I definitely, when I talk about notes, unlike the stock market, it's very a roller coaster, volatile. And I say in the note business, if things go well, you make your return and collect your money and collect your
Mhm.
cash flow, and that's great if things go well. If things don't go well and the worst of the worst happens and the buyer defaults, you can get the house and still make money.
Yeah,
you
you
know?
just put on your real estate investor hat and you can
Yeah.
fix and flip it. You can rent it out. You can sell or finance it again. You can flip it to a simple wholesaling. I mean, you can you can
Yeah,
do you can do a lot of variety of things. That's why I love being the bank, because you really have all the options.
definitely. I want to spend the last section of the show here really just talking about due diligence
Okay.
and what are some of the questions and things that a note investor needs to look for when they have a note comes across their table. Like, what should they ask and what should they be looking for?
Well, the first thing they need to figure out is if it's a performing loan or a non-performing loan, because the due diligence is going, as you know, is going to be a little bit different between the two. We'll just focus on performing now, just because that's just the easiest one to talk about. So when a note comes across your desk, you basically look at it and saying, okay, what are the factors of it? Meaning, what are the terms of the note? So the interest rate, how long the note is, the payments, the monthly payments they make, the principal and interest. You want to see, is it what state it's in? You want to see, what the collateral is. That's very important. You want to see, obviously, the pay history. I mean, there's basically 6 main factors to it. The borrower has a little bit to do with it. The down payment has a lot to do with it as well. So depending on what these 6 factors are, there could be like 3 or 4 good ones and 2 like really bad ones, but they kind of average out to be okay. Or vice versa, you could have a couple of really good ones and 3 or 4 just kind of mediocre ones, as far as those 6 values, and then they kind of balance out. So you're never going to have a note that's going to have all 6 values be like an A. You're probably going to have a mixture of B, C, maybe D, and then you just kind of figure out where is your comfort level in investing in that deal. So a little bit higher risk could be a little bit higher return. A little bit lower risk is going to be pretty much a little bit lower return, but It's going to be very predictable.
It's kind of like the class neighborhoods, A
Yep,
class, B class, C class house.
exactly.
Definitely. So
Exactly. You get
those
what you pay for, right?
are, that's right. That's right. I'm going to go through some questions here and ask you if these are important and these kind of go along the due diligence process that a
Mhm.
lot of people have been asking me. So just to kind of like, are these important? Yes or no? And then
Okay.
why to you?
All right.
So when you look into the note, property value, like, is that important? I mean, you're really not buying the property, but is the property value important to you?
That's a great question, because yes, it is important to me for the fact that if I'm investing in a $50,000 note and the property value is $30,000, I need to build that into my calculation or my bid to the seller and be like, okay, I'm not going to pay $50,000 for this $50,000 note when the property is worth $30,000. That would be ridiculous, right? I have no protection. So that is really important that you look into the property value. But you bring up a good point, because you're not investing in the property, you're investing in the borrower, really.
Interesting.
Yeah.
So the property value is important, but
Yep.
not as important as the borrower.
Correct. Yeah. Yeah.
Okay.
It's important to the point to where you want to make sure it's worth more than what you're paying for it. Is the number one question.
No, yeah, definitely. And how do you normally get a property value? Like, do you just look it up on Zillow or
Right.
what do you
So
do?
that's the $1 million question, because nobody really knows what the value of a property is, because it's only worth what a buyer and seller agree to when they come to a contract, right? So what I realistically do is I look up the values online, like a realtor.com or an RPR, or the Redfin, or any of the online valuations tools, just to get an idea of what it could be and what the street value is, as far as like the homes like that on that same street. And then when it comes down to it, I'll actually go out and get an exterior appraisal of the house. So we'll send out like a BPO or a local realtor to give us some comps and to give us some values of what they think it is. And that's the best determination to find out what the value is. On some of these lower value homes, like 50,000 and below, or really 80,000 and below, we go off the income approach a lot. So what is the rent data in that area? So we can find out what the value of that home is for conventional financing based off the rent data.
So you mostly get like a BPO,
Mhm.
realtor's opinion, broker's price opinion.
Mhm.
Do you ever get like a full appraisal? Does anybody ever do that?
You can, if you get access to the interior of the home. You can, most certainly can, but you got to get permission from the borrower to do that. And typically that's not going to happen.
They're like, who are you? What do you?
Yeah. Yeah.
Get
Get out of my house.
Definitely.
Right.
So property values are important. They're not as important as the borrower. Loan to value ratio. What does that mean? Why is that important?
Loan to value ratio is exactly where the borrower's at in this promise to pay. So if they borrowed $100,000 and they paid down $5,000, then obviously they have a 95% loan to value ratio, which is a very high ratio. So it tells you how much skin the borrower has in the deal. Obviously minus their down payment. So if they had a low down payment and they have a high LTV, they either haven't been borrowing this money very long, or they just have had very little skin in the game so far, and it's a little bit more of a riskier deal. So it's earlier in its infancy of the note, as opposed to someone having a large down payment and seasoned for a couple of years and maybe having a 60% LTV, 60% loan to value. So maybe they owe $60,000 on a unpaid balance than when it was $100,000.
Awesome.
So it is important. It's something to look at, but it's not the number one factor, because there is no number one factor. There's just several factors to look at, and you just kind of make your best determination if that deal is going to work out for you.
Definitely. So the more skin that the borrower has in the game, the better they're probably going to perform. Would
That
you
and the
say?
less risk you have as the bank,
Right. Because if you
right?
get the property back, you have a
Yeah.
lot of equity into the deal.
Yeah, which is why commercial banks always require large down payments and lower LTVs to fund those deals, because they have nothing really else to compare it to. So they feel like it's higher risk for them. So that's why they require 40% down payments and things like that.
Awesome. Sounds good. Payment history. So let's talk about that. Is that important? Was
Absolutely, it's my favorite one.
Okay.
It's
That's
my
your number
favorite
one.
one because on performing loans, it tells you the entire story that you really need to know about this Mr. or Mrs. Borrower.
Mm.
It shows, do they pay on time? Do they pay a few days late? How do they pay you? Do they pay you early? Some of them even pay via ACH, as you know, just an electronic debit every month on time. And then it just kind of builds a story for you. So if they missed a payment, that's understandable. Did they make it up? Just other things like that. So pay history is really important. It really tells you the story. So if someone has a low down payment, but they have a 7-year pay history, well, I'm kind of okay looking at the down payment going, that's not as important as noticing they have a 7-year pay history. And so maybe they didn't have a lot of cash up front to pay down on the property, but they show that they're very vested in this deal and they do have some significant skin in the game.
Awesome. Sounds good.
Yeah.
Seasoning of the note. What does that mean, and is that important?
So seasoning kind of goes along with pay history. Seasoning is what we say in the business of basically how long have they been paying. So a seasoned loan is something that's been paying for probably almost about a year and longer. A very unseasoned loan or a newer loan or something in its infancy, it'll just be a few months. So those deals can still be bought and be good deals, the ones that aren't as seasoned. But the longer the seasoning, the more of a story you have. So it kind of goes along with pay history. So seasoning is good.
Gotcha. So you're really just kind of looking for the story, it
Yeah.
sounds like. And that's like
Yeah.
why banks check credit reports. It tells the
Yep.
story, and
Hmm.
their bank statements tell the story, and all these
Exactly.
things
You
tell the
can't hide from that stuff.
story. Right,
Right.
definitely.
Yeah.
So underwriting of the loan, and this is something that we can obviously dig a lot into, but like,
Yeah.
is that important? And what are the most importance when you're like underwriting the buyer?
Well, the number one reason why we underwrite borrowers really is their ability to repay that debt. So we look at it as they make so much money a month, they bring in so much income a month as a family or as borrower and co-borrower, and the payment on their mortgage potentially is going to be this. What is that ratio compared to their entire debt to income? And do they have the ability to repay and not be at risk of being over leveraged? And so banks don't look at it in that perspective. Big banks look at it as what's your credit score, what's your credit history, and then if your ratio is 40 some percent, then we say it's okay. We as note investors aren't as concerned with credit history and credit score as we are their ability to repay. So if they make $5,000 of income coming in a month and they have $1,000 mortgage, well, that puts them at a 20% debt to income ratio right there, unless they have other debt they owe that would push them up higher and higher and higher. So we focus on the ability to repay more or less in underwriting. So we do look at their IRS records, we do look at their bank statements, we do look at their W-2s and things like that, just to make sure that can you repay or not, because we don't want you to default. We want you set up for success from day one.
Yeah, definitely. And that's kind of the initial thing. But your underwriting process, that part is looking at the payment history as
Mhm.
well, right? I mean, that's like one of your
Right.
underwriting requirements.
Yeah. So if you're creating a loan, you definitely would go through that underwriting, like we just talked about. But when you're purchasing a loan, you're looking at that seasoning on that pay history, because that's going to tell you everything you need to know. So we don't look at it as we have to go run credit or run the borrower under any underwriting scrutiny at that point, because the pay history and the down payment really tells us a lot about the borrower. And so we don't have to dive too deep into it. Now, on the flip side, on a non-performing loan, someone that's not paying, we may have to look into them a little bit more and to find out what the story is, because maybe they just lost a job and maybe you can help them out by purchasing the debt at a low cost, and you can help restructure the deal to make it more affordable for them. And it could be a very, very lucrative win-win for everybody.
Yeah, definitely. Amount of down payment. So is that important?
Absolutely. So it's important in the fact that, like we talked about before, if you have a long seasoning or long pay history, then down payment isn't as important. If you have a very short seasoning or short pay history, down payment is pretty important when I'm deciding if I want to purchase the deal or not. So it just shows how much vested interest or how much skin do they have in the game from day one.
Awesome. So again, kind of going back to having more skin in the game for
Yep.
the borrower. Loan servicing companies. So is this something that you highly recommend, using a third-party loan servicing company to help collect the payments, or if you were to buy a note, would you collect the checks and pick up the money yourself?
I don't want the brain damage of collecting the check and figuring out the unpaid balance. Even if you have an Excel spreadsheet, if they pay 2 days later than the due date, then guess what? Your amortization's off. I mean, there's all these things that you don't even need to give yourself brain damage. For usually less than $30 or $25 a month, you can have a professional service the loan. I mean, they'll collect the payments for you. They'll push the payments out to you. They'll talk to the borrower. They'll help them out if they need to. And they pay the taxes and insurance out of their escrow account as well. So we highly recommend loan servicing companies. I've never collected a check from somebody as being the bank. I just let the loan servicer handle it.
Yeah, no, that's good. It's awesome. Short-term or long-term notes. So what do you see, what do you recommend, or what do you see other people mostly like recommend when they think, and I don't even know short-term versus long-term, how many months or years is the difference, but I know you can have a 30-year note or a 2-year note. So like,
Yeah.
what do you think people kind of recommend?
It seems that the most investors prefer to go the short-term route. I think this holds true that they just want their investment back as quickly as possible. So they would probably prefer to have a shorter term note. The borrower would prefer to have a longer term note because then they can stretch out their payments and they can be lower monthly and they have a longer time to pay it back, which helps them out. So short term and long term, there is no right or wrong answer. We typically in our portfolio, we're going to invest in longer loans. So loans that are probably between 180 months and 360 months. That'll be 15 years to 30 years. And other investors like those 12-year, 7-year, less than 15-year notes because the principal and interest monthly payments are a lot higher. So they receive a lot more cash flow coming in, but the debt is paid back a lot quicker. So the principal is paid a lot more on shorter term loans and less interest. On longer term loans, the interest is a lot more and the principal is a lot less on those monthly payments as they build up over time. So it just kind of depends on how you look at it. But the way that we look at it is that about every 7 to 9 years, what usually happens with a property?
They usually pay it off, refinance it.
Exactly. So the time value of money actually in our math, it seems to be more profitable if we just wait and hold on. And if it pays off earlier refis, like you said, it becomes a lot more lucrative for you. And all that interest was kept from the beginning and they have to repay all that principal back that they haven't paid yet. So we like the longer term loans, but there is no really wrong answer. So that's the best way I can describe the short term and long term loans.
Awesome. Sounds good. I got a couple more questions and we'll wrap up the show here, but character of the seller. And when I say that, I'm talking about the character of the person who's selling the note, right? We've already talked about if you're creating a note and you're seller financing a property, the character of the buyer, that's the underwriting process, and you look at their story. But what about the story of the person selling the note?
That's a really good question. And not a lot of people take that seriously in the note investing world because you really should. I'm sure there's plenty of horror stories out there that I could mention about people misrepresenting selling a loan just because that's what they do. I'm sure they do that in real estate as well. In fact, I know they do that in real estate as well. You just want to vet who you're dealing with. You want to make sure they are the owner of the loan, or if they're not the owner of the loan, find out, are they the one brokering the loan, as we call it. You want to make sure you don't have a daisy chain of different brokers, because if you're not dealing with the principal buyer or the principal seller on either side, things can get lost in communication pretty quickly when you're going through the bidding process or going through trying to negotiate a deal for the loan. Because the last thing you want is somebody misrepresenting the loan. Then you get the loan and basically it's an air note. There's nothing to it. Someone sold you some funky paper.
Yeah.
And you definitely don't want that to happen. So you want to vet them or talk to a note investor professional that can help you vet the seller, especially if you've never worked with them before.
And that was just kind of leads me to one of the last questions here is, when you buy a note, do you go through like a closing process like you do when you buy a house through a title company? What's that what do you see look like?
So typically in the note world, we do virtual closings to where we don't go through a title company, but you absolutely can go through a title company to close it. Typically, people, when they buy land contracts or contract for deeds, which are not note mortgages, but they're a little bit different to where you're the note holder is actually on the deed. Then you typically you might want to consider going through a title company because you just want to make sure you're conveyed a clear warranty deed title and there's no other defects on it. Otherwise, when you're the note holder, when you sell a note and mortgage, you're just transferring the ownership of the rights of the note and mortgage to another person or another entity. So you don't really need a title company because there's no real liens to worry about. You're just kind of checking some due diligence, checking taxes and things like that. And then virtually through a closing, the seller just writes an assignment that says, I'm assigning the interest of this note over to Simple Wholesaling, or the mortgage interest to Simple Wholesaling.
Awesome. Sounds good. Last question, and then we'll wrap up today. But we hear the word yield a lot. And what are some of the expectations? I guess talk to us about what is yield, number one, and what are some of the expectations? Like, how much cash flow can someone make? What's like a typical range or whatever that people make off these?
So this is another one of my favorite questions. So I'm glad you brought this up. Is people have ROI they hear about, and they have yield they hear about, and they think they're the same, but they're actually not. So we'll just back up for a quick second and say an ROI is return on investment. So to get a return on your investment, you have to have the investment mature, right? So if you bought a house, you put money into it, then you flipped it to somebody else, then you look backwards and you say, okay, I made this much money and that was my return on my investment. A yield is different. It's future. It's predictable. It's projectable. So it's looking into the future of what your return is going to be on an annualized basis. So a yield is what we talk about in note investing. So we gauge our profitability off of what yield is. So a typical range of what I call a retail note investor, someone that's not in the business like me, is probably going to be somewhere in the 6 to 8% yield range at full maturity. So if it's projected to be 26 years till the loan's paid off, then that's what you would make over 26 years. But if the loan paid off in 4 years, well, the return's going to be a lot greater because of the time value of money. So that's the main difference between yield and ROI. So that's what my answer would be for yield would be. People would expect to make around 6 to 8%.
Yeah. And I love it because it's predictable, right?
Yeah.
It can be more predictable than some of the other investments out there. And awesome. Justin, well, thank you so much for being on the show today, man. I really appreciate you answer all the questions. We covered so much in the 30 minutes that we've been talking, but I know that you also do some education in Indianapolis about notes, but where's the best place someone to like find out about you if they have any other questions about notes?
Yeah, I appreciate you. Let me plug in. So, you can see our little slogan in the back here. We've got the deal flow to make your cash flow. So my company is Bright Path Notes, and you can look at our website, brightpathnotes.com, brightpathnotes.com. And you can reach us through there. We got a telephone number on there, and we got an info@brightpathnotes.com email address if you have any more questions. Yes, we definitely try to educate. We do a lot of free stuff monthly. We have monthly meetups we do with virtual meetings as well. So yeah, I look forward to helping anybody out that I can. And I appreciate being on your show, Brett.
Yeah, no, I appreciate you, Justin. Awesome. Well, if you're listening out there and you have any more questions, reach out to Justin at Bright Path, or you can reach out to myself. You can look us up on Facebook. Just search for Brett Snodgrass and ask me a question in the messenger there. If you guys are interested in any other topics that you want to talk about Indianapolis real estate investing. And with that, that's a wrap. Thanks, Justin.
All right, Brett. Thank you, man. Have a good one.